The trend is your friend. If you've spent any time learning about trading, you've heard that phrase. Markets don't move in straight lines, they zigzag. Up, pullback, up again, down, bounce, down again. Those zigzags, the peaks and troughs, move in a direction, and that direction is what we call the trend. In the next 10 minutes, I'm gonna break down everything you need to understand trend lines, how to spot them, how to draw them, and why they matter. Quick note before we start, this is educational content. Nothing here is financial advice. So let's start with the basics. Every market moves in one of three directions. First, uptrends. When you see prices making higher highs and higher lows, that's buyers gaining ground. Each rally goes a bit higher than the last, and each pullback stops at a higher level than before. Then there are downtrends, the opposite. Lower highs and lower lows. Sellers are in control. Each bounce is weaker and each drop goes deeper. And third, sideways. This is where both the peaks and troughs flatten out. No clear direction. Supply and demand are balanced and neither buyers nor sellers can take control. A lot of traders find this frustrating because most strategies are built to follow trends, not to trade equilibrium. Some experienced traders work with range setups here, but for most people, the cleaner play is just to wait for a new direction to emerge. Now here's where it gets layered. Trends don't just exist in one time frame, they exist in three. The major trend, that's the big one, it can last months, even years. Think of it like the tide. Inside that, you've got intermediate trends. These are shorter moves that last a few weeks to a few months. They act like corrections or pauses within the bigger picture. And then there are minor trends. These are the quick swings, days, maybe a couple of weeks, the ripples. So you've got small trends moving inside medium trends which are moving inside the major trend. And that's why a chart can look bullish on the daily time frame but bearish on the weekly. You're just looking at different layers of the same structure. Alright, now let's get practical and draw some lines. For an uptrend, you're looking for the lows, the reaction lows as they are sometimes called. You need at least two of them. The first low forms, then price rallies. Then it pulls back and forms a second low, ideally higher than the first. Connect those two lows with a straight line and that's your tentative trend line. Tentative because you don't know yet if it's valid. To confirm it, you need a third touch. When price comes back down and bounces off that line a third time. That's your confirmation. And now, that's a valid trend line. For a downtrend, same principle, just flipped. First high, rally fails. Second high forms, ideally lower than the first. Draw your line. Wait for the third touch. Now let's talk about why those peaks and throws actually matter. In an uptrend, the lows, the throughs, are called support. Support is a price level where buying interest is strong enough to halt a decline. Price drops to that area, buyers step in, and it bounces back up. Usually, a support level is identified by a previous reaction low. That's a spot where buyers defended before. The peaks are called resistance. Resistance is where selling pressure shows up. Price rallies to that level, sellers defend it, and it gets pushed back down. In a downtrend, it's the same concept, just flipped. The highs are resistance, where sellers keep pushing price back down, the lows are support. Though in a downtrend, support doesn't hold permanently. It slows the decline temporarily before breaking. Here's what's really interesting. Support and resistance reverse their roles. When a resistance level gets broken, when price finally pushes above it and holds, that old resistance often becomes new support. This role reversal happens constantly in markets, and there is a reason for it: psychology. Think about it. Let's say a support level forms where buyers have been stepping in. Those buyers are now in profit if price goes higher. But if price drops back to that level, they're happy to buy more. Meanwhile, anyone who sold at that level and watched price rally is now looking for a chance to buy. If price comes back down, they might jump in. All that buying interest, that's what creates a support. And when support breaks, when price closes below it, all those buyers realize they made a mistake. It's not magic, it's psychology. And it's why previous peaks and troughs matter. Because when you draw a trend line, you're not just connecting random points. You're connecting support levels in an uptrend or resistance levels in a downtrend. One more thing, not all trend lines carry the same weight. A line that's been intact for months and tested multiple times is more significant than a fresh 3-day line. Why does that matter? The more significant the trend line, the more important its break. Most traders were watching it, more positions were based on it. When that line breaks, it carries weight. So here's where trend lines get tricky. Price breaks through the line, looks like the trend is over, but then price comes right back and the trend continues. That's what we call a fake breakout. So how do you tell the difference between a fake and a real break? Here's the truth. You can't, not with certainty. Some traders say, watch the candle size. Small candles equals fake and large candles equal real. Others say, wait for a close beyond the line. Others say, wait for a 3% penetration. Everyone has a rule. None of them work 100% of the time. Why? Because markets don't follow rules. They follow participants, and participants can change their behavior. So what's a practical approach? Here's one way some traders handle it. They wait for price to break the line, then wait for a pullback to that broken line. If the line was support and it breaks down, they wait for price to rally back up to test it as a new resistance. If it gets rejected there, that's their confirmation. That's where they might consider an entry with a stop above the old support. If the line was a resistance instead and it breaks up, same idea flipped. Does this guarantee success? Absolutely not, but it gives you two pieces of information instead of one. The break happened and the role reversal confirmed. That's more context than just reacting to the first candle that breaks. Still, there's no formula, just pattern recognition built over time. The more charts you watch, the better you get at reading this situation. That's the reality. Once you've drawn your trend line, here's another tool you can add. A second trend line, parallel to the first. In an uptrend, your main line connects the lows. Draw a second line through the highs, parallel to the first. That's what we call a channel. What you'll often see is price oscillating between these two boundaries. It drops to the lower line, bounces up, rallies to the upper line, pulls back over and over. When price approaches the lower line in an uptrend, that's where buying interest has appeared before. When it rallies to the upper line, that's where selling pressure has shown up. Not every trend forms a clean channel, but when you spot one, it adds context. Here's something else. When a price breaks the upper channel line in an uptrend, it often signals acceleration. The trend is strengthening. Some traders even redraw a steeper trend line when that happens. On the flip side, when price fails to reach the upper channel line, when it tops out below where it should, that's often an early warning the trend might be weakening. The channel gives you boundaries, and those boundaries help you read what the market is doing. One last concept, the fan principle. Sometimes when a trend line breaks, traders draw a second line at a flatter angle. Price follows that for a while, then breaks it. They draw a third line, even flatter. When that third line breaks, the trend is usually done. 3 strikes. Here's what's happening. Each break shows the trend losing momentum. It's weakening in stages. The lines gradually flatten out, resembling a fan. That's where the name comes from. The breaking of the third line is usually the valid trend reversal signal. Alright, let's wrap this up. Markets move in peaks and troughs. The direction of those peaks and troughs defines the trend. To draw a trend line connects the lows in an uptrend, the highs in a downtrend. 2 points to start, a third to confirm. Support and resistance explain why those lines work. Channels add boundaries. Breaks signal potential change. None of this guarantees success, but it gives you a framework for reading market structure. Now, here's the thing. You don't need to burn through live accounts to gain experience analyzing charts. What I suggest if you're interested is to practice on a simulator first. All the charts in this video were created using Pro Realtime. There's a link in the description. You can use it to practice without risking real money. And yes, you'll eventually need to learn to manage emotions with real capital. But to succeed in trading, emotions needs to be mastered through discipline and process, not through burning accounts.